Well, my next guest expects a bit of a zing in the zinc market over the next couple of years. Mark Lackey says an increase in infrastructure and auto production will combine to boost demand. And Mark is Executive Vice President of CHF Capital and he joins us now with that. Zinc, tell me about zinc right now.
Well, zinc right now trading around 83 cents a pound US on the NYMEX. And basically, it's been pretty much range bound in the last couple of years, Pat, kind of in the high 70s, low 80s, low 90s. And we expect that over the next 3 to 6 months. But as we go into 2014, we think by the end of 2014 we'll be at 120, and by the end of 2015 we'll be at 140. And it's largely a function, as you pointed out, of some stronger demand in residential, non-residential, and auto sales, plus the infrastructure programs that have been announced in 5 or 6 countries, including China, India, Indonesia, where you get more demand for zinc when you spend money on infrastructure than, say, if you did quantitative easing, for example.
Okay, now are we leveraged into the Chinese economy with zinc? Do you have to have the Chinese economy booming to get that?
No,
bang?
I wouldn't. I would argue that as long as we have a Chinese economy that's certainly decent, I'm not looking, and have said all along, we didn't need 9% in China as long as we had 7.5, because intensities are rising in countries like China and India. In other words, your GDP, for 1% of GDP, you use more zinc and more copper, with all the people moving from the farm areas to the cities, 20 million a year in China. So that alone boosts zinc demand. Plus, as I said, infrastructure programs have been announced and are going forward in China. So again, people should recognize I don't need 9% growth. If I've got 7 to 7.5, it's still pretty favorable for commodities like zinc.
And the Chinese make their own zinc too.
Well, they do. They mine it and they export, in fact, high quality zinc, and there's been some discussion that may end. So if we do look at from a supply side, Pat, I think that's one of the key factors here, is that if China stops doing that, my forecast is probably a bit on the low side. And the reason I am very positive on zinc is the fact that a number of mines are being shut in the next 2-3 years, about 10 of them, and most notably the Brunswick mine in New Brunswick, Lachine in Ireland, and Century in Australia. So you're going to take about 1.5 million tons out of the market. So I think that with somewhat stronger demand and somewhat significantly lower supply, we will start to see a rising price for zinc next year.
Where do I get the leverage? What kind of a stock do I buy?
Well, you know, it's interesting. I had some of the viewers phone me last week saying they'd like to see a mid-cap instead of a small cap. So I looked around and thought, well, the best mid-cap player is Hudbay Minerals. That's really a good leverage play to zinc. They also have copper and gold production. I like the fact that it's an experienced management. They have cash flow. They're in very good jurisdictions. They're largely a North American play with some operations in South America. And they have, I think, a lot of potential on their land to find even more zinc and copper. So I think the best leverage play among the mid-cap players is Hudbay Minerals.
Okay, that's the mid-caps. Are there small caps that are involved in zinc space, per se?
There sure are a few. I mean, I've looked at things like, Canadian Zinc. They have an interesting play. There's just not that many of them. There's maybe, 4 or 5, and some of them are very greenfield. So, if people want to take some risks, that's great. But I think that I'm sticking this week more to a mid-cap player because they are very leveraged given the amount of production they have. So it's almost like playing a small cap to some degree, except you're taking away a fair amount of the risk because it's already a fairly low-cost producer.
Are they zinc exclusively?
No, they also have copper and gold, and so the advantage is they have some copper and gold credits. They're largely a zinc player, but the fact that they have copper and gold, the diversity is good because it obviously lowers the cost of zinc, given that you are able to sell the copper. They produce about 100,000 ounces of gold a year, so that's not insignificant.
The price has been volatile for zinc
Absolutely.
in the past. I mean, what are the risks that we get back to? I think you were saying they got as low as 40 cents.
Yeah, well, in 2008, all the commodities got hit extremely hard, and zinc did get that low. I think that, first of all, we know the supply that's going to leave the market is going to happen. So what's the biggest risk? Obviously, the biggest risk would be that demand doesn't go down significantly. So if you have a view out there that you think world growth is going to slow dramatically, particularly in a number of the emerging markets, then that's probably the biggest risk you're running. I think when I look at Hudbay, the execution risk is not really there because they've executed along the lines of what they said they were going to do. So I think your biggest risk is world growth. There are concerns. Some people think China is going to crater. I don't buy that, especially given it's a new government and they have instituted things like infrastructure programs, which do tend to support economic growth, as I said, somewhat better than I would argue than even quantitative easing.
A lot of people haven't been following the zinc price. I mean, it's one of those little anomalies in the marketplace. Is there something you can look at as a lead indicator? Like, do copper prices and zinc prices, are they related to each other?
To some degree. You know, they have some similar markets, but I would say to people that if you want to look at the zinc market, okay, take a look at housing starts, take a look at housing permits, not just in the US, but across the world. Take a look at what's going on in terms of plans for non-residential construction, and also get a view on where auto sales are going. And so if you can stay in those markets, those are the key markets. It's not so much important what may happen in some other consumer durable markets. But yes, it I think is going to perform better than copper in the next few years because of the supply situation, which you don't have the same supply constraint in copper that you do in zinc.
Extra bang for that buck.
Exactly.
Mark, great to have you in.
It's great to be here, Pat.
Great that you did a mid-cap, too.
That's right.
Mark Lackey, Executive Vice President at CHF Capital Markets.